Hi friends, this is Arun from the research desk at FundsIndia. Now these are very unusual times and I hope you and your loved ones are staying home and staying safe. Now unfortunately at a time like this, the equity markets are not making our lives any easier. The markets after the coronavirus issue has been extremely volatile and they're currently down somewhere close to 30-35% from the January peak levels. Now, such a sharp correction in such a short period means for any equity heavy portfolio, the performance would look very poor at this juncture. In fact, even a 5-year equity SIP return would have been very low. So now the obvious question running in most of our minds is, should I stop my equity SIPs and move out? Now these are very genuine concerns and we completely understand your frustration and anxiety. Spare us a few minutes and we will try and address all your concerns. So the first starting point is to intuitively get a hang of why and when an equity SIP works. Now one of the best ways to understand this is to look at how a lot of us buy gold via monthly installments. So whenever gold prices decline, we are reasonably happy because we get to accumulate more grams of gold for the same monthly installment amount. And the inherent belief here is that gold prices will eventually go up over the long run, and hence the more the grams of gold I am able to accumulate at a lower price, the better it is for me in the longer run. Now when you really think about equity SIPs, it's a very similar concept. History shows us that Indian equity markets, while there are several periods of short-term declines, over the long run have always gone up. So as markets will eventually recover in the future, logically, whenever the markets go down like what we are seeing today, we are actually at an advantage because we get to accumulate more mutual fund units at a far lower cost for the same SIP amount. The only challenge here is that since equity investing culture is still very nascent in India, we don't intuitively get long-term conviction in equities like how we have it for gold. In case of gold, obviously we have built the conviction over several decades, several generations. So no doubt about the conviction there. But when it comes to equity, whenever there is a market correction and prices go down, it is very scary. And we suddenly lose the conviction that in the long run, equities will go up. So the starting point to have a very good experience while investing through equity SIPs is the inherent faith that equities, or in other words, Indian entrepreneurs over the long run will provide us with very, very good returns. Now we are basically betting that the overall value of a diversified group of companies spread across sectors and run by talented entrepreneurs over the long run will move up significantly in value. So just like how we accumulate grams in gold, if we start looking at SIPs as accumulating units in mutual funds, then suddenly the entire perspective changes. As we expect the NAVs to eventually go up in the long run, whenever there is a sharp correction in prices, we should take advantage of this as we can accumulate more and more mutual fund units for the same monthly SIP amount. Now, assuming roughly a 30% fall in the last 1 month, and I mean that's been the fall in the last 1 month, and let's assume the previous month you only accumulated 100 units of your mutual fund, this month you would have accumulated almost 43% more, that is 143 units. So the first perspective change is that as long as you believe that Indian entrepreneurs and companies will continue to do well over the long run, this is a phenomenal time to collect more units of your fund at a far lower cost. Eventually, when the market recovers, this will lead to significant improvement in your SIP returns. Now, while this sounds logical, it is intuitively still difficult to imagine how in the world will my returns recover from these very, very low paltry levels. How in the world will they recover? Now, instead of going blindly by what I am saying, let me take you through a very interesting study that we recently did. So what we did is we went back 25 years and analyzed the long-term SIP returns for investors who had started in different months. So that is what would have happened to somebody who started their SIP, equity SIP on January 1995, February 1995, March 1995, and so on and so forth. So for equities, we have taken the Nifty 500 TRA index as the proxy. Now the first bad news, historically there have been periods where the 5-year SIP returns were dismal. By dismal I mean less than 5% returns. Since 1995, there has been 40 months or 17% of the total instances where if you had started your SIP in the Nifty 500 TRA index, the 5-year SIP returns were less than 5%. Now let that sink. Now while this is not something that you must be excited to hear, here is some good news. In 17 out of these 40 instances, had you extended the SIP, equity SIP for just one more year, the returns dramatically improved to more than 13%. And in fact, the average return was close to around 18%. Now in the remaining, out of the remaining instances, 15 instances, had you extended it by just 2 more years, the return significantly improved to more than 11%, and the average return was somewhere close to 15%. And in the last remaining 8 instances, you had to extend it for 3 more years, and then suddenly the returns jumped to almost more than 12%, and the average return was around 14%. So the key takeaway for us from history is that while the occurrence of such 5-year SIP periods with muted returns is not very common, whenever they happen, investors who, despite their frustration, continued their SIPs for another 1 to 3 years had a significant recovery in returns, averaging around 15%, and even in the worst case, they had a return of about 11%. Now the next logical question is, how does this happen? The first key point is that Indian markets have always recovered from their falls, always. While we don't know when the recovery will happen, whenever they happen, they are extremely fast. In fact, in the last major crisis of 2008-2009, which was the subprime crisis, the recovery was a whopping 85% in the first 3 months. And then after that, for the next 1.5 years, it went up somewhere close to around just 40%. So first 3 months, 85%, and in the remaining 1.5 years, somewhere around 40%. So 3 months is all it took to recover your SIP return significantly during the last market crash. Now looking at the pace of the fall this time, we shouldn't be surprised if the recovery is also extremely fast whenever that happens. So the key for us as smart investors is to understand the simple logic behind an equity SIP and to take advantage of the current lower prices by continuing our SIPs. In fact, a lot of our experienced investors have even increased their SIP amounts to take advantage of the current lower prices. Now, for those of you who are interested to know more, you can also refer to our recent blog on this topic. To sum it up, while this is obviously a frustrating and a very anxious phase for all of us, history informs us that waiting a little longer and continuing SIPs has always led to significant recovery in returns. As always, we are there to help you, and do reach out to us if you need any help. Stay safe, stay home, and stay invested. Thank you so much for your time.